This is the continuation of the cash flow statement question. First thing we looked at was our abridged profit and loss, and we got a final operating profit figure of 79,750. Now we're looking at the reconciliation of operating profit, which we had at 79,750 above our operating profit, and we're working at getting from our operating profit down to our net cash inflow from operating activities. So what this means, we're trying to get from operating profit to a net cash inflow. I'm going to show you a P&L. This is a normal P&L starting from our sales, and I'm only just showing it down to operating profit. Operating profit is what we worked up towards. Now we're at this point. Okay, we're trying to look for our net cash inflow. Basically, to get from operating profit, you had to subtract a good few things here. You had to add this, and you had to work through the trading part as well. But there are a number of things within this trading profit and loss account that do not affect cash. The easiest one to think of is depreciation. I have depreciation in buildings here of nearly 19,000, and I have depreciation of vans here of 38,000. So I have a lot of depreciation here that is reducing my profits, and it's bringing my operating profit down because it's too expensive. But depreciation has nothing got to do with cash. It doesn't change my cash at all. From a cash perspective, if I get loads of depreciation on a van, I don't have to hand over that depreciation in cash to anybody. It doesn't affect my cash at all, but here I am reducing my profit. So what we're trying to do when we're working towards our net cash inflow is we're actually trying to see whether we made cash or we lost cash this year. And to do that, we just take our operating profit and we just change the figures that don't affect cash. We go back to this and we just get rid of the figures that don't affect cash. So what doesn't affect cash? There are a good few things here. Not all of them come up in cash flow question. Profit and sale of van is one of them. You made a profit on the sale of a van, but you valued the van at a certain amount. That's how much you valued it at. You had depreciated it by a certain amount over the course of the years. There was no specific transaction that you made 2,000 or 1,000 or whatever the profit was. Yes, you received cash from it, but that's separate. That was through with the bank, and we'll look at that later on. But from our profit on sale of van, we didn't actually make this 3,250 at all. It's fabricated, so it didn't change cash at all. Bad debts provision is the assumption that not all of your debtors will pay you back. If you increase that, again, it doesn't change cash. Depreciation doesn't change cash. Bad debt written off, well, you haven't received the money from them yet. They're debtors that haven't paid you back. Doesn't change cash. That one does not show up in a cash flow question. Depreciation, as we said, it doesn't change cash. Patent or goodwill written off. The idea that I own a patent on an item and I'm just going to write it off over multiple years. Nothing got to do with cash. From that point, I'll just scroll up. I'll get to the others later on. So these were four of the things that we discussed below. Depreciation, this one is a loss on disposal, goodwill written off, an increase in bad debt provision. This is an expense. Loss on disposal is also an expense. Goodwill written off is an expense. An increase in bad debt provision is an expense. They're all expenses. So when I did my P&L, I took all those expenses into account and it reduced the value of my profit. But none of them have got anything to do with cash. So I want to get rid of them from my accounts. In other words, I'm going to add them back to my operating profit and pretend they never existed. So for all four of these figures here, they're all expenses. I'm going to add them all back in. So I had the four of these back in, and we're going to work out how much the figures are. My operating profit to begin with, that I had at the start from my reconciliation from last year, or from the first part, was 79,750. I can plug that figure in straight away. That's 79,750 is given at the start of the question, or given from our part A. Now, um, the reconciliation is different in the sense that depreciation is normally seen as a bad thing, so I reduce it from my profits and I'd find out what my profit was excluding depreciation. But as we said, this has got nothing to do with cash, so I want to get rid of it. I don't want to see it. So to get rid of it from my operating profit, because I previously would have reduced it because it's an expense, I'm going to add it back in. Not all of these will always be expenses. As an example, like below, profit on disposal could just easily be there. And if there was profit on disposal there, I would take it away, because profit on disposal is income. But more often than not, most of these figures you will add back in, they are expenses. The following three figures I'm going to get to as we go along. I'm just looking at the first four first. So my depreciation. How do I get my depreciation for the year? Well, I have a bit of information here on depreciation. I have 80,000 from the beginning of the year and I have 125,000 from last year. But if I look through the bottom of the question, it tells me that I had assets costing 70,000, which had a disposal amount of 27,000. This 27,000 is gone from the accounts here, but technically part of it should be depreciation for the year. Now, in a cash flow question, you're never given information regarding when this depreciation happened and how many months are for this year. So you actually have to assume that all 27,000 was an expense for the year. How that works out is that I have to do a note now on my depreciation. So my depreciation note here, I'm going to start with the balance I had at the first of the first. And the balance I had at the first of depreciation was 80,000. The next thing I'm going to look at is my disposal. And we're told in the question that I had a disposal of 27,000. I'm going to put this depreciation out from the balance of the first, and it gives me a remaining balance of 53,000. Now, to get from 53,000 to my balance at the end of the year, which was 125,000, which I'm going to show you here, I have a missing figure. And that missing figure is going to be my depreciation for the year, 72,000. So to go through it again, I have my depreciation at the first of the first, which is 80,000, but I have depreciation at the end of the year of 125,000. But during the year, I would have disposed of an asset, and the depreciation on that was 27,000. And therefore, this has to be taken into account. My depreciation didn't just jump up 45,000 from 80 to 125. It has to actually include this 27,000 here. Once you take it out, you get this value. This is what my depreciation was for the year, 72,000. So you just basically start from the first of the first and you work towards the 31st of the 12th by taking away the disposal, and then this is the missing figure, 72,000. I'm going to plug that in straight away. So 72,000 is my depreciation for the year. Now, my disposal, I'm going to do a normal account, which I've done in many other questions, to find out whether I made a profit or loss on disposal. How do I do it? Well, I take the cost of the first for my fixed asset, which was 70,000. This is my disposal fixed asset, sorry, it's not the first. It's just the cost of how much the asset was that I disposed of. The depreciation was 27,000, and therefore if I take away the depreciation from the cost, I get a net book value of 43,000. I made 41,300 off this sale. So it originally cost 43,000. I received 41,300. Therefore, I had made a loss, and the loss is 1,700. A loss on disposal is usually an expense, but because it has nothing to do with cash, I'm going to add it back in. Loss on disposal, 1,700. So these are usually expenses, but I'm going to add them back in. My goodwill written off. Well, I'm told at the bottom of the question here that my goodwill is to be amortized over a 6-year period commencing in 2018. Careful of the wording, commencing in 2018. This starts in 2018. So when you go up to the goodwill figures, you see your goodwill figure for 55,000 at the end of the year and 66,000 for the end of last year. But if my goodwill is to be amortized over 6 years, it started in 2018. This is my goodwill figure at the beginning of 2018. So that's the figure I work off of. My note is going to be, so goodwill written off. I have my balance at the first of the first, which is the first of the first, which is 66,000. I'm going to amortize it over 6 years. So 66,000 divided by 6 years is 11,000. That's my goodwill for the year. I don't have to worry about taking this 11,000 away from the 66 and finding out my goodwill at the end of the year because it was given. 11,000 is my goodwill for the year. Again, it's an expense, so I'm going to add it back in because it's got nothing to do with cash. The last one is quite easy. My provision for bad debt that I see here at the beginning of the year was 1,200. At the end of the year, it went up 400. So it went up, my expense went up 400. It's got nothing to do with cash, so add it back in. The last three. Now, to explain the last three in the same way they explain the others below. My debtors, creditors, and stock. So, what are debtors? Debtors are when people owe you money. They bought something off you and they haven't paid you yet. In other words, they're credit sales. So debtors form part of this. And if I increase my debtors for the year are the people that bought off me on credit and they haven't paid me back. So that's where debtors comes into the P&L. My creditors again comes in purchases because that's people I owe money to because I got an item and I haven't paid for it. So my creditors for the year are my credit purchases that I have not yet paid back. The stock, 75 and 81 here. The difference we have between our stock up here is also taken into account. Because if you think of it, stock actually doesn't exist in terms of a cash transaction. When we pay for cash, or when we pay with cash, we pay for new stock. That's purchases. So from terms of a cash format, we pay for purchases and we hand over the cash. The stock is just how much you count up. In terms of a cash format for transactions during the year, stock doesn't come into it. It's purchases that comes into it. So I'm trying to get rid of the stock here because, again, it doesn't really have anything to do with cash. It's just the amount of items I have left in a warehouse. I'm going to get rid of the debtors, decrease in debtors. Sorry, I'm not getting rid, so it's a decrease in debtors, but I'm actually going to add it. So I'm adding my decrease in debtors. And the way to think about this here, my decrease in creditors is going to be the opposite. I'm going to take it away. The way to think about this here is if you decrease your debtors, it's usually a bad thing in the sense that you have less money that's coming into you. But technically, they've paid that money. My debtors was 56,000 and now it's 54,000. That difference has actually been paid to me. So I've received it. I'm gonna add it on because it's cash. It was 56, now it's down to 54. There's a 2,000 difference here, and that 2,000 is going to be added. My creditors, I see here, was 72, and it dropped to 64, a difference of 8,000. Now I'm going to take this away because my creditors have been decreased. It means I've actually paid off some of my suppliers. So the effect that's had on cash is that it's reduced the amount of cash I have. My stock, whenever you increase stock, you're going to take it away. So my stock here I have was 89,000 and it went up to 107,500. I'm going to take away the increase of 18,500. Leaves me with a final figure once I've added all those up of 140,350. Now, just to make this a little bit more clear, we're given the operating profit at the start, and we have to work towards this net cash inflow. None of these figures generally are too complicated to work out. I mean, these figures here, we've just literally looked at the difference between and bad debt. We looked at the difference between last year and this year. They're generally quite easy. You sometimes don't even need a calculator to find out the difference. Now, the goodwill, we just amortized it over 6 years. And the two here, we just did a little account to find out, okay, whether I made a profit and loss on disposal, and finding out here how much depreciation I had for the year. So again, this is worth about 20% of the question, and they're generally not that difficult. The difficulty comes in remembering the format and knowing what to add and what to take away. That's the part that catches people. And if you can understand that and you don't have any problem with it, then it's a handy 20% of the question to get. So again, operating profit is given at the start. These next four here in this question were all expenses. If something is an expense and it's a non-cash item, I'm going to add it back. Don't assume that these will always be expenses, because if this is profit on disposal, it wouldn't be an expense, it'd be income, and this would be a minus. But for this question, depreciation is an expense, loss on disposal is an expense, goodwill written off is an expense, and increase in bad debt provision is an expense. I add all those in because they have reduced my profit, but they haven't affected my cash, so I'm going to add them back in. The way to look at these is to see whether it is a good thing or a bad thing. I've decreased the amount that I'm owed, but technically they've paid me, so I'm going to add it back in. They've paid me that 2,000 cash. I'm decreased the amount that the debtors owe me, but the 2,000 has actually been paid towards me. It's had a positive effect on my cash. My decrease in creditors means that I've paid off the 8,000 difference. I've given that money to the suppliers. The money's gone, the cash is gone, therefore I'm going to take it away. And the stock, if there's an increase in stock, you take it away, you do the opposite of what you'd assume in your head. And if you have a decrease in stock, then you add it. Basically, if it says increase here, take it away. If it says decrease, you add it. Why? Because stock doesn't affect cash. It's purchases that affects cash. So I just want to get rid of the stock from the question. Hopefully that should clear up the reconciliation of operating profit to net cash inflow.